This is Al Brooks, and this is my price action trading course. This module is about trading a strong bear breakout. A strong bear trend, it does not matter what you call it. You can call it a strong bear trend, a breakout, or a spike. All of those terms are synonymous. However you call it, the important thing that you should remember is that you have to sell. Okay, what are the signs of a strong bear breakout? First of all, big bear trend bars, especially consecutive strong bear trend bars. Small tails, closes near the low, big bodies. And also you'd like to see the context supporting lower prices. The big picture has to make sense. You got to make sure that it's not just a sell vacuum to the bottom of a trading range. Once you see a strong bear in the breakout phase, dropping bar after bar after bar, you have to get short. To make money, you have to do what the institutions are doing, and the institutions are shorting. If you look at the volume of those bars and those bear spikes, it's heavy, and the market is falling quickly, and it's because institutions are selling repeatedly. Okay? So if you're not short, sell at the market. One of the problems traders face is they'll see the bear spike growing and growing and growing, and they know that if they short, their stop is way up at the top of the spike, and they're risking far more ticks than they normally like to risk. It doesn't matter. Calculate how many ticks you have to risk and adjust your position size, but you have to get short. If you don't sell at the market, you have to get short very soon. For example, you can sell at the close of any strong bear trend bar, and if you're in a strong bear spike, sell at the close of a bull trend bar. The bull trend bar is an attempt to reverse the trend, and most reversals fail. You can sell below the low of the prior bar and above the high of the prior bar, because if the market goes above the high of the prior bar, it's trying to reverse, and the reversal, probably 80% chance, will fail. You also press bets and sell breakouts below swing lows. So if the market is falling and pulls back and it falls below that old low, you can press your bets and sell on a stop one tick below the prior low. And also you want to sell any small pullback. When the market's in a strong trend, the trend entries always look bad. There's always something wrong with them. It always looks like the market is trying to reverse. For example, here's a doji signal bar. Here you're far from the moving average, bottom of a tight channel. Maybe it's overdue for a correction. Here you're following 2 bars up and you have a doji signal bar. The market always looks like it's set up for a regression to the mean, that it's gone too far and that it has to correct. But when you're in a strong trend, it does not have to correct. It can go a long, long way. When a trend is very strong, one way you can enter is looking for a micro trend line failed breakout. So you look for a bear micro channel, you look for a breakout above the bear micro channel, and that sets up a low one short setup, and you can sell one tick below the low of the bar as the market resumes down. So a small bear micro channel, a failed breakout above the top of the channel, so you sell at one tick below the low of the bar. Same with over here. Same with over here. And even more so over here when the market is in a free fall. Yes, an attempt to reverse, but most reversal attempts fail, especially when the market is falling with consecutive bear bars and the bars are getting bigger and bigger and bigger. So you got a pullback, it breaks above the micro channel, and that sets up a signal bar for a short. Even though you have 2 consecutive bull bars, it's a reasonable short, one tick below. Certainly for a swing, maybe for a scalp. There are stock replacement strategies for bearish positions, and if a trader finds that his stop has to be so far above his entry price that the position would be so small it's not worth taking, yet he feels the trend is strong and he wants to participate, he has a stock alternative. He has an alternative to his stock, and that is in the options market. He could buy a put, or he could buy a put spread. let's say he's sold way up here and the market's way down here, and his stop has to be much higher up than what he is comfortable using. He could just buy back his stock, his short, for a profit, and then go ahead and put on an option position like buying a put or buying a put spread, and that will allow him to continue to participate on the downside. There are other alternatives like ratio put spreads and calendar put spreads and put flies, but they're beyond what I want to discuss in this course. Here's an example of a bear trend in the spider on the daily chart, and I want to talk about it in two different ways. Let's say you are flat and you see this big bear spike occurring late in the bear trend, and you decide that the market is going down more, and you're correct. That makes sense whenever the trend is this strong. And you decide you want to sell, to go short, but your stop might be above the top of this bear spike. It might be above the most recent lower high. It might even be simply above the beginning of this bear spike. In any case, let's say it's further away than you want to risk, yet you want to participate on the downside. A good alternative is to simply go ahead and buy a put. You can wait for a pullback and buy the put at the market, or you can wait to see if the market trades below the low of the prior bar, and at this point buy a put. If you buy a put here and the market goes up here, that's $2 on the spider. You might be very nervous if you shorted the spider, but if you bought an at-the-money put, maybe you paid $2 for it here. At this point, it might be down to $1, but your risk is still $2. Even if the put goes to zero, you lose no more than $2, and it allows you to hold on. And at this point, you might be able to exit your put for $3 and have a $1 profit. You might not be comfortable emotionally had you shorted here, the spider, if the market ran up, $1 or $2 above your entry price. But the put is a good alternative to that. The other alternative is that I was talking about is, instead of being flat down here and then wanting to get short, let's say you were short from up here and now the market's down here, and you think, gosh, my stop has to be above the bear spike or above the lower high, and that's far more than I want to risk. Let's say it's 5 times more than I want to risk. You can reduce your position size to a 20% size, but if the position size is so small that you don't want to continue to hold, you can replace your stock position, your short spider position, with a put. So you simply buy back your stock for a profit. If you sold it up here, you have a big profit, and you can then go ahead and buy a put or a put spread to try to capture any additional gain that the market might offer you. Understanding breakouts and how to trade them is one of the most important skills you can develop as a trader. Breakouts, when strong and successful, usually have a second leg. So in other words, once the market breaks out, there's a pullback and then a second leg. And they often go for some kind of a measured move based upon the size of the spike or the size of the trading range from which they broke out. And breakouts often fail. And traders all the time have to decide what to do once they see a big breakout. So for example, if there's a news report or an earnings report on a stock, and the stock opens with a big gap up, you'll hear traders on television like Fast Money on CNBC. I don't get any money from Fast Money. I'm just mentioning them because it's a popular show. You'll hear the traders say, big gap up on news, do we sell it? And you're saying, wait a minute, why are they talking about selling a big gap up? Shouldn't they only be talking about buying? Not necessarily. They'll look at the big picture. They look at all the bars to the left. If the market is in a very strong bear trend, they'll assume that the breakout is just a buy vacuum up to test resistance, like maybe the top of a channel, and they'll look to sell. You'll also have other traders who'll say, big gap up, maybe it'll break out above the bear channel if it's in a bear trend. What a great opportunity to buy on strength, expecting follow-through buying. And neither the bulls nor the bears are all that certain. Remember, the 60-40 rule, most of the time the probability is between 60 and 40%. And that is really true. Anytime the market gaps up big, the market's trading, there will be institutions buying and other institutions selling. And you have to assume that both the bulls and the bears are profitable. Most institutions are. And how can both a bull make money buying and a bear make money selling at the same time? It's because of trade management. If they look at the big gap up, they'll say, I don't know, maybe 50-50 chance it'll go up or down. They will have to risk half of what they're going for in terms of reward. They'll have to decide where the protective stop is, and they'll have to go for a reward at least twice as big. They don't specifically say, oh, what do I need to get a positive trader's equation? How big a reward do I need for a positive trader's equation? And that's not what they do. They look at worst case stop, and then initially they'll go for a target twice that size. If the market starts to go their way without getting anywhere near their stop, they'll take a look at how far the market went against them before it started to resume in their direction. At that point, they'll base a target on the actual amount of money that they had to risk on the trade. One thing you'll never hear traders say is, oh, it gapped up and now it has a hanging man pattern or a dark cloud cover. Okay? Traders are not interested in that stuff. It's nice, right, to have a signal bar. It's much more important to have context. Where are you in the market cycle, and is the market at support or resistance? That is the overwhelmingly most important thing that you need to know as far as taking trades. And then next, you have to know how to manage your trades. For example, when you take the trade, if you're very confident that the trade is good and that there'll be follow-through, chances are it will not go very far. So you probably have to scalp more, swing less, and go for a smaller target, maybe 1 times your risk. On the other hand, as is the case most of the time, you look at the chart and you say, oh, I don't know, maybe it'll keep going, maybe it'll reverse. Okay, when that's the case, you should go for a reward at least 2 times bigger than your risk. So when you see the market gap up or down on a report, remember, there are institutions who will buy that gap, and there'll be other institutions who will sell that gap. Both, if they see this identical trade 10 times, will be profitable because of their trade management. And it will have nothing to do with the doji bar or the candlestick pattern or any other thing in terms of reversal patterns or continuation patterns on candlesticks. Let me give you an example. Here's Nike, daily chart of Nike, and it was in a bear trend, not a strong bear trend. It's a channel. Channels are weak bear trends. Lower highs, lower lows, and then it gapped down big on a news report. I think it was an earnings report. And you look at perfect doji star, a very big bar with a perfect close right in the middle, no body. So candlestick traders get excited. Oh, wow, a doji star in a bear trend, this could be the end of the bear trend. It can, but if you watched Fast Money or any business show on that day, you did not hear any trader saying, oh, wow, big gap down and a doji star. If it goes above that bar, it's a buy. Nobody said that. What they said was, do you think it's cheap enough to buy? Do you think it's overdone? Do you think it's at support? Do you think the support's below and it has room to go on the downside? That's how traders talk about it. So it's not the doji pattern that they're interested in. They're interested in all the bars to the left. I don't have much on the left here, but in actual fact, this is fairly close to the bottom of a trading range, a support area. And very often, when the market has a big gap, it trades down to the support area, and all of a sudden, bulls appear. And you say, wait a minute, why didn't the bulls prevent the gap from happening? Well, if you're a bull and you think it's going to test support, why buy here if you think it's going to reach here? So they just wait until it gets here, and then the bulls start to buy. And the bears, if they think it's going to get to support, they're going to sell aggressively all the way down. Even if there's a gap, they'll sell the open, expecting it to go down a little bit further. They may only scalp, but they're going to sell. And this is what resulted. The bears probably scalped, bought back the shorts, and that lifted the market up here. And the bulls, when it got down to what they thought was support, they started buying, and it lifted it to here. nobody was talking candlestick patterns. Candlestick patterns are for home traders, people like you and me, and they're part of the setup, but they're not the setup. The setup is the support and the resistance, all the stuff to the left. The signal bar is the doji pattern, but the reality is most institutions are placing bets and they're totally ignoring this bar. They don't care. They just are interested in whether or not the market is down to a support level. And then they place a bet. They take a chance. Here's a common situation where you have a bear breakout where the market flips to always in short. So we have a bear bar, another bear bar, another bear bar, and then a bigger bear bar. So we have a bear bar bigger than the one before and another bear bar, and breaking out. We have lower highs, lower lows, right? So at some point traders say, it's a bear channel, it's not just a trading range. And at this point, by the close of this bar, most traders would say, yeah, I think it's always in short. It was pretty good. It was in a bull leg up here and then a pretty good bull leg here, some buying here, but this strong 4 bear bar spike was enough to make me think that the bears have control and that the market is going lower. When the market's always in short, what do? You got to look to get short. In this particular case, we have an II pattern, a small triangle, and you could short below it, or you can say, I don't know, these bars they're good, and it's enough to make me think we're going lower, but the big picture is that of a weak bear channel, in which case the market will probably bounce, and I should be able to sell higher. But I don't know, maybe it'll accelerate to the downside. So traders can short below this bar, they can short at the market, they can short the close of this bar, right? But we have tails on the bottoms of the bars, so some buying. The bodies are big but not huge, so the bears are not all that strong. A lot of traders will assume that this bear spike will be followed by a pretty good pullback. And here the market rallied for about 10 or 15 bars. And it in fact formed a low four short in a bear channel. We had a push up here, okay, so that sets up a low 1. We had a second push up here, sets up a low 2, did not trigger. Then we had another breakout, a pullback, and a second breakout. So 4 pushes up, that makes it a low 4. You can also argue wedge bear flag, a push up here, and then 2, 3, 4. Doesn't matter, sometimes wedges have 4 pushes. In any case, this is probably going to be a bear flag. Traders could short, as I said, the close of the breakout bar. As soon as they decided it was always in short, they could sell there. They could sell below this bear bar. But they're looking for a swing. The market's in a bear trend, and they just decided at this moment that it's in a bear trend. So they're looking for a swing. And where does their stop go? Above the top of the spike. You could put it above the most recent lower high, or above the top of the bear spike. The bear spike began with this bear body. To me, I would probably put it above the top of above the lower high. And once you decide that it's always in short, you keep looking for opportunities to sell until the market becomes always in long. And here we formed a triangle, 3 pushes up, 1, 2, 3. You can call it a triangle, you can call it a tight trading range, you can call it a double top bear flag. It does not matter. But what does matter is it's always in short. It did not become always in long. So the bet is that it's going lower. And you look for reasons to short. And it's better to short below bear bars, but when you have a low 4 setup and always in short market, you can short below a bull bar here. Here we got a bear bar closing on its low after a little rally. It's a sell. Here we have a couple bear bars, and we have a doji bar here. You can sell below these bear bars, another breakout. Bear bar closing on its low after a pullback to the moving average. It's a short. Bear bar closing on its low, relatively big bar. That's a short. Another big bear bar closing on its low. That's a short. Even though it traded up here, it's still a short. And you trail your stops above the most recent lower high. So every time the market goes to a new low, the stop goes above the most recent lower high. So at this point, it fell below a low. So this stop goes down here. Here we broke to a new low. So the stop would move from here down to above this double top. The point of this slide is whenever you have a breakout and the market converts clearly to always in short in the eyes of traders, You can short for any reason, but if the breakout is not all that strong, you have to rely on a protective stop that is above the top of the bear spike, and that sometimes means you'll have a rally that goes on for more bars and covers more points than what you might normally expect. But that's still okay. You know, you decided it's always in short as long as it stays below the top of the bear spike, and as long as it does not clearly become always in long, it's short, and you can keep shorting and you rely on your protective stop. As with any trend, you should try to swing at least part of your position, especially when the trend is very strong, when it's in its breakout phase. If you're trying to scalp, for example, if you're selling closes, looking for scalps, you have to use a tighter stop because you're going for a smaller profit, but make sure that the reward you go for is as big as your risk. Advanced traders can scale in both as the market goes against them and as the market goes in their favor. They can keep selling closes and adding on as the market goes down. Okay, if you have a successful breakout and you look at it and you say, wow, this is going down, then you're 60% sure that it's going down and the probability is high. You have to sell for any reason, even if it's at the market. If you wait for a pullback, you may wait a long time and you may end up missing the best part of the trend. The market is just falling point after point after point after point while you're waiting for that pullback that will allow you in with a smaller risk. You end up missing a huge trend. You're never going to be more than 60% certain, so you can't be paralyzed by the 40% chance that you're wrong. 60% is as good as it gets. And if you're going to be trading as a living and for a living and you see a 60% setup, you have to take it. Even if the risk is big, the stop is far. Trade small and take the trade and rely on the stop. Once you're convinced or strongly believe that the market is always in short, sell at least a small position, right? Just get in the market. And if the market continues your way or if it has a pullback, build your position up to its normal size. I talk more about breakouts and trading strong trends in other modules. So when you're in a strong bear breakout, the spike phase of a bear trend, one way to get in is simply sell the close of the bar. So if you have a bear bar and another bear bar, just sell the close, right? And put your stop above the top of the spike. If there's no pullback and the market falls quickly, 2 points, 3 points in the E-mini, scalp out part or even all, because your actual risk probably was small. When you start to see consecutive strong bear trend bars and the context is good for lower prices, you have to get short. You cannot wait for a pullback because the trend can go a long, long way. Here we have a very large gap up, first bar of the day closing on its low, and then we have two other bars with bear bodies. Here's a second entry short. A pretty good chance that it's a swing short. Possible that this is the high of the day. It's certainly a good looking bar and the context is good. A very big gap up, far from the moving average. And then when you see this very strong entry bar, had you taken that short, you look at this and you say, well, at a minimum, it should get down to the moving average. When you have a second entry short, both good looking bear bars, and you have a very strong bear bar breaking far below the low of the opening range, the market is going to go lower. Well, market's going to go lower. That means it's always in short. You sell the close, put a stop above the high. You look and you say, well, that's 5 points away. I don't want to risk that many points in the E-mini. That's okay. Trade 1/3 size, trade 1/4 size, but trade something just to get short. All right, the next bar, what do you see? You see confirmation that the bears are in control. They were obviously in control of that first very big bear bar. And now we have another bar closing on its low, which is the follow-through bar. So we have follow-through selling after the original bear breakout. Well, I would assume the market's going lower. Again, sell the close. All right, so the market went down, but now it's popping up with a tail. It's still always in short. There's no reason to buy here, and that means that there are sellers above. Where's your stop? Probably, to be safe, above the top of this bear breakout bar. The market probably will not get above the high of this bar either. There's a gap here between the low of this bar and the high of that bar. And at the moment, it's a breakout gap, and the gap is starting a bear trend. So I think you can sell this close, but your stop is higher up. You can also sell above the high of the bar, but we're getting a tail and we're near support, the moving average. So I think if you're flat, I would go short, or certainly short any pullback. But if you're already short, I would just hold short. Resumption of the strength. Another breakout bar, closed below the low of the prior bar. Yes, it could be a buy vacuum test of the moving average, but to me, it's another strong bear bar, and we're going lower, probably going lower. So if you sell the close, your stop is probably somewhere up here, and just trade small, but make sure to trade. Make sure to get short. 2-bar reversal. So if you sold that close, you have a problem right now. What do? Well, if you're a beginner, you either rely on your stop and take your chances. If you're a more experienced trader, you're going to bet that this is going to have a second leg down after such a strong sell-off, and you're looking to short. You might short above the high of this bar. You might short that bear close. That bull close. Traders who shorted down here at the moving average, they have a problem. Experienced traders, they might not have shorted a close at support, the moving average, but if they did, they probably traded small enough so that they can add on higher and still rely on their initial stop. Better for the bears, a 2-bar reversal sell. We had a 2-bar reversal buy, but the context was bad. We're in a strong bear trend, so the market probably was going to have sellers above the high of any bar. If a trader's flat, I think it's reasonable to short below this, or they could wait. This is strong enough up, these 2 bull bars, so that we might go sideways. And this is what followed. Another bear breakout, another follow-through bar, another bear close, another bear close. Lower low, possible bounce here at the moving average. But through here, certainly sell closes. I usually don't sell closes if the market is at support. The market went sideways to up for the rest of the day, or for the middle third of the day, and then the bear trend resumed later in the day. We had another strong bear breakout. The follow-through bar, a doji. It had the minimum confirmation needed for a bear trend. It did not have a bull body. It was not a bull reversal bar. Next bar, bear body. Next bar, bear body. Yes, tails, so not strong, but still always in short, probably with a stop above the high of this bull bar, maybe a couple ticks above the bottom of this, above the high of this bear bar, maybe a couple ticks above the low of this bull bar. And you can continue to sell closes as long as the market continues to have consecutive bear closes. A big breakout at the end, so now we have consecutive sell climaxes right here, and then slower. Another big bear bar, another climax, and now a third consecutive climax. The market may soon have 10 bars, 2 legs, sideways, 2 up. So I would not sell that close. Also, it looks like we're around a leg 1 equals leg 2 move. The height of this leg looks like it's about the same as the size of this leg. So I probably would not sell that close because I think a lot of bears will look at it as a gift going into the close. Wow, that's unexpected. We have a very big bear bar in a trend that has gone on for a long time, and it's the third consecutive sell climax within the same bear spike. I didn't think it was going to give me that. I'm going to just buy back my shorts. Aggressive bulls will probably buy that close for a scalp up to the moving average. So where do you put your protective stop when the market's in a strong bear breakout? Initially, if you sold below this bar, your stop is above its high. Once you had a huge bear bar, let's say you sold the close, let's say you sold here. At this point, you would move your stop to above the high of the strong bear bar. Another fairly strong bear bar, and there's a gap between this low and that high. Some traders would put their stop just above the top of this bar. It has a strong enough body, plus we have a gap, and the bear should try to keep it open. Once the market started to trade down here, traders would lower their stop to one tick above its high. This is basically a double top bear flag. This high and this tail is a small double top. Okay, we're starting to get tails. We've got two strong bull bars. We've got more tails, some overlap, a bull reversal bar. The market might be transitioning into a trading range. Once it transitions into a trading range, I'm looking to buy low, sell high, and scalp. And I'm no longer looking to swing, or if I swing, I'll swing very small. This looks like it might be transitioning into a trading range, and so I want to buy low. We're low, so I want to buy. I'm not necessarily going to buy to get long, but I will buy to take profits on my shorts. This is a good location to take profits on shorts. If you shorted this bear spike or any of these bear closes, your initial stop is above the top of the spike, above the high of this bar. Another bear breakout, if you short these closes, your stop now goes above the high of the most recent big bear breakout bar. In the strongest bear trends in the breakout phase, you want to sell low one pullbacks during the initial spike down. Once the trend weakens and begins to form a bear channel, you look to sell low two pullbacks, two-legged pullbacks, more complex pullbacks. For example, we have a strong bear spike and then a pause. This is the you could short this as a low one. You could short this as a low one. Here, you can argue it's a low one. You can say bear micro channel, first breakout above the bear micro channel, it should fail, and it's a low one. Or you can argue it's a double top with this bull bar. Double tops are rarely at the same level, but it is a double top, a push up and then down and another push up. So this is a low two short, or you could wait to short below the low of the bear bar. Another bear breakout, so you start the count over again. First pullback, bear signal bar, a low one short. We go on further. Another pullback on this bull reversal bar, bear inside bar, another low one short. You sell below the low of that bar on a stop, you get filled right over here. Here you can call it a low one or a low two. We have about a 15 bar bear micro channel, 15 consecutive bars or so, without a bar going above the high of the prior bar. So the first time that the market goes above the prior bar, traders will look to short the resumption of the trend. So they'll short one tick below the low of that bar. Sometimes in a strong bear trend in the spike phase of a bear, the breakout phase of the bear, there'll be a pullback, maybe a one bar pullback, forming a low one short. However, sometimes the low one short does not quite look right. And when that's the case, you can use your actual risk to set your profit target. If it's unclear whether or not the trade looks good, aim for a target that's 2 times your actual risk. If the probability looks like it's very strong, 60% or better, you can exit with just 1 times your risk, and you will have a profitable trader's equation. If you look at it and it's questionable, then you can only make a profit if you take 100 of these trades. If you're going for a profit twice your risk. Whenever the probability is 40 to 50%, you will not make money unless your average profit on your winners is 2 times your risk. So let's take a look at this bear trend. Okay, trading range up through here, and then a very strong bear breakout. Maybe we'll get a trending trading range day. Maybe this will become a spike and we'll get a channel. So anyway, here's the first pullback, and this is a low one short. The first pullback after a breakout, I think, is a fairly high probability trade, and in general, I would go for at least 2 times my risk. So if you sold below the low of that bar, where's your stop? To me, if I'm taking this trade, my stop is going to be above the high of the bear spike, maybe the breakout bar here, or maybe the top of the lower high. So my initial stop is going to be the swing stop up here, and that means I trade it a little bit smaller. On the other hand, if I wanted to just go for a scalp, I could trade my normal position size and put my stop 1 tick above the signal bar, especially since it's a bear body. You can argue on a smaller time frame it's a double top, this tail, and then here. So on a smaller time frame it's a low 2. So if I took it as a scalp with my stop up here, Okay, I think that's a high probability scalp. So technically, I could exit with one-time risk. The trend looks like it will probably get a measured move down from the height of the spike. So it probably, from here to here. So a measured move down would be somewhere here. Realistically, I probably would try to swing part of it. Here we have a potential spike and final flag, 1-bar final flag. The move down here, small bars, tails, starting to get some buying pressure. This is not a strong buy signal, so I would not look to buy. But here we have a bear microchannel, 5 bars down, and a pullback. The market broke out above the bear microchannel on this small bar. Okay, so arguably that's another low one short. So you could short below its low. But where is your stop? Would you put your stop 1 tick above the high of the bar? I would not. When you get a small doji after a doji, too much risk of a tight trading range, and the market going up a few ticks, down a few ticks, and going sideways for a long time. So where's your stop at this point if you took this short? To me, the best stop is the swing stop. I think the market went always in short on this bear breakout, and as long as we stay below the most recent lower high, the market's in a bear trend and always in short. But you're saying, well, I don't want to risk, that's like, $1 in the spider. That's right, it is. It's a big risk. So if you take that short and you use the swing stop, you have to trade very small. If the trade quickly goes your way, you take your profit. If, on the other hand, it goes against you, as it did here, it triggered the short below this bar and then immediately reversed up. You would have been stopped out if you put your stop above the high of the signal bar. To me, I would not have put my stop there because, at a minimum, it might come up and test this high. We may try to form a double top bear flag at the moving average. Realistically, it's still on a short as long as it remains below the most recent lower high. So I would not put my stop there. I might put it, a few ticks above this bar because the bears should be able to keep it as a double top and below the moving average. But the ideal stop is either above the start of the bear breakout or a few ticks higher above the bear spike. So your initial stop is up here. Similarly, we have another bear breakout here. Okay, after a series of 4 bars, we broke to the downside. So we have a potential bull flag and double bottom, and instead of breaking to the upside, it broke to the downside. Normally, when the market does the opposite of what is likely, it usually has at least 2 legs. So there's one push, it should have a second push down. And so it's reasonable to short below this bull bar. The bulls see this as a consecutive sell climax, an exhaustive move. There's a sell climax, another one, and then this, and then this. So they see it as an exhaustive sell climax. They see a bottom of a channel through here. So they see a failed breakout below the channel and a reversal up. I personally would not take that long, although it could have been the low of the day and we could have traded up. On the other hand, I'm faced with this low one short. I think the odds are we'll get a second leg down because we should have tried to go more sideways here and instead we broke to the downside. So the lower probability thing happened, and that usually means the market will have a second push. But let's say I took this. My stop is probably several ticks above the high of this bear spike. If we do reverse, the first target is the top of the bear spike. Normally the market goes a tick or two above and runs the stops and then enters a trading range. But let's say I took the short here. I could have used either the top of the bear spike or the most recent lower high for my stop. In either case, I'm risking a lot, so if I took this short and I was trying to get some kind of a swing, I got to use the swing stop here or here. And to me, the probability is not all that high at this point because of what I said. It could easily be an exhaustive sell climax and end of the move. I don't have a measured move drawn in here, but this could be a measuring gap. So we have an upper range measuring gap, and this is in the neighborhood of a measured move down from this high to the middle of this gap down here. That's around a measured move. The middle of the gap is from the low of this bar to either the high here or the high here, probably the high here. So from this low to that high, that's the gap. So the middle of the gap is around here. The measured move is from there to the middle of the gap, and you project down, it would come right in this general area. So that is support. So you're buying a failed breakout below a bear trend line. You're shorting a failed bear breakout below a bear channel, which and the market should reverse up. So it's a lower probability trade. So if you take it, you should be shooting for 2 times your initial risk, which is either the swing stop here or the swing stop here. The market continued up for a third push, forming a low 3 short, a wedge bear flag. You could add on to your shorts here. You could add on to your shorts here, assuming your position size is not getting too big. But in any case, initially, until the market starts to resume down, I think you're basing your profit targets on your initial risk, which is up here or up here. And this is what happened next. Okay, the market had a strong bear bar, so you could tighten your stop to 1 tick above its high, or 1 tick above this small wedge top. 3 pushes up, 1, 2, 3. So instead of your initial risk, which was above here, now you know that your actual risk was just 1 tick above the top of the pullback. So as this bear bar closes, you know that your actual risk was to 1 tick above its high. Had you had a stop above that high, and you did not know at the time that the market would turn down at this point, but if you had a stop there, you would not have been stopped out. So the minimum location, the minimum price for your stop, where you would not have been stopped out, turned out to be 1 tick above the high of this bar. So you actually only risked from your entry price 1 tick below this bar right here to 1 tick above this bar, and you knew that by the close of this bar. So you could set your profit target at 1 time risk, 2 times risk. I probably would go for 2 times risk, given that the 1 time risk is too small given the size of this trend. Okay, but anyway, you could take half off maybe at 2 times risk, move your stop to break even, and try to swing the balance. So you would have exited over here. Similarly over here, when the market started to turn down, we have a bear bar here, we have follow through here. So either on this bar or on that bar, you discovered that the actual risk for your short below here or your short below here was 1 tick above. Well, for your short below here, for sure, it's 1 tick above here. So you entered here, you entered right here below this bar, and as the market started to turn down, you would not have been stopped out had you had a stop 1 tick above the high of this bar. So you found out that your actual risk was just 1 tick above the high of this bar. Your entry price was 1 tick below this bar. When you took the trade, maybe a 50-50 trade, we may have gone sideways. You could go for a reward equal to 2 times risk. And you'll notice that very often when the market gets down to 2 times actual risk, you get profit takers. And that's what happened here, right? So you were not alone looking at actual risk. The same with over here. Here's your actual risk, entry price to 1 tick above the biggest pullback. And here's 2 times actual risk, right? And what happened? The market went sideways for 10 bars. That tells you that a lot of traders are doing the same thing. They're looking at actual risk and taking partial profits. And that is the end of my module on trading a strong bear breakout.